The six stages. Since there are three financial markets and each has two turning points, it follows that there are conceptually six turning points in a typical cycle. I call these the six stages, and they can be used as reference points for determining the current phase of the cycle. The six stages are indicated in Figure 2.4. When identifying a stage, it is important to look at the long term technical position of all three markets so they can act as a cross check on each other. The stages are also useful in that specific industry group. The stages are also useful in that specific industry groups outperform the market at particular times and vice versa. For example, defensive and liquidity driven early cycle leaders tend to do well in stages 1 and 2. On the other hand, earnings driven or late cycle leaders perform well in stages 4 and 5 when commodity prices are rallying. These aspects are covered more fully in Chapter 22 on sector rotation. Figure 2.4. The six stages of the typical business cycle. Stage 1, Stage 2, Stage 3, Stage 4, Stage 5, Stage 6. Longer cycles. Some expansions encompass much longer periods and they usually include at least one slowdown in the growth rate followed by a second round of economic expansion. This has the effect of splitting the overall expansion in two or three parts, each of which results in a complete cycle in the financial markets. I call this a double cycle. An example of this phenomena is illustrated in Figure 2.5. A double cycle developed in the 1980s and another in 1990s. In the mid 1980s, for example, commodity and industrial parts of the country were badly affected as a result of the unwinding of the commodity boom that ended in 1980, but the east and west coasts continued their expansion unabated. The strong areas the strong areas more than offset the weaker ones, and so the country as a whole avoided a recession. Figure 2.5. Financial markets peaks and troughs in a double cycle. The role of technical analysis. Technical analysis comes into play by helping to determine when the various markets have turned in a primary way. This is achieved by applying the various techniques outlined in subsequent chapters, moving average crossovers, changes in the direction of long term momentum, and so forth. Each market can then be used as a cross check against the other two. For example, if the weight of the technical evidence suggests that bonds have bottomed but the commodity prices remain in a bear market, then the next thing to do would be to look for technical signs pointing to a stock market bottom and so forth. This analysis has performed. This analysis has also formed the basis of the Dow Jones Pricing U.S. Business Cycle Index, symbol DJPRING, as shown in Chart 2.1. The index uses models to identify the six stages and then allocates assets and equity sectors based on their historical performance in each stage since the mid 1950s. It is far from perfect, but does show cons- it is far from perfect, but does show consistent long-term results. This methodology is also used in the Pring Turner business cycle. Chapter 2.1. The Dow Jones Pring Business Cycle Index Performance versus three asset classes. Performance Annual Standard 1956 to 2011. Return Deviation Bonds 3.44, 6.81, Stocks 6.83, 13.40, Commodities 7.95, 15.10. Dow Jones 10.05, 9.70, Pring Index Source S&P Dow Jones Index. ETF symbol DBIZ. The exchange traded fund ETF does not seek to replicate the index but rather to beat it on a risk adjusted basis. Market experience. 1966 to 2001. Chart 2.1 shows how peaks and troughs developed for the various markets between 1966 and 1977. Please note that inversely plotted short term interest rates have been substituted for bond prices. There is much closer link between equity prices and short term rates than with long term ones. That is because corporations do more for their borrowing in the money markets than in the bond markets. Short term rates are also more volatile than those at the end of yield spectrum. The peaks and troughs turned out very much as expected. While chronological sequence was more or less perfect, the leads and lags in each cycle varied considerably because of the different characteristics in each cycle. In 1966, for instance, bonds and stocks bottomed more or less simultaneously, whereas the lag for the commodity market bottom was well over a year. Chart 2.2 shows the same markets, but this time we are looking at 1980s. The two small upward pointing arrows in 1982 and 1990 reflect recessions. Such environment represent good buying opportunities for bonds, but terrible ones for owning commodities. The series of three bottoms that developed between 1984 and 1986 reflect the mid 1980s growth recession. Generally speaking, the chronological sequence works satisfactorily until we get to the late 1980s, where the 1989 bottom in rates is just exposed is juxtaposed with the stock market peak. Unfortunately, these out of sequence events are a fact of life. In my experience studying the 200 years of out of sequence relationships, I find they represent the exception rather than the rule. Chapter 2.3 shows the closing years of the 20th century. This is the most difficult period I have encountered because of the record performance by the stock market and the strong deflationary forces associated with the technological revolution. This had the effect of reducing the nominal this has this had the effect of reducing the normal cycle fluctuation in the equity market. In the fourth edition of this book I said, since the stock market boom was unprecedented, it is unlikely that the normal chronological sequences have been more than temporarily interrupted. Chapter 2.4 proves the conclusion to be mostly correct, except for the late 2001 low in commodities that preceded equities. Chart 2.3 Three financial markets 1980 to 1992. Short rates inverted S&P Composite. Chart 2.4 Three financial markets 1989 to 2001. Short rates inverted S&P Composite. One could still argue, though, that the equity market lagged because it was still in the process of unwinding the tech bubble. Remember, it continued to decline even after the 2001 recession ended. Note the double cycle that developed between 2010 and 2012 in chart 2.5. Summary: a typical business cycle embraces three individual cycles for interest rates, equities, and commodities. All are influenced by the same economic and financial forces, but each responds differently. These markets undergo a chronological sequence that repeats in most cycles. Some cycles experience a slowdown in the growth rate and not an actual recession. Even so, the chronological sequence between markets still appear to operate. The leads and lags vary from cycle to cycle and have little forecasting value. The chronological sequence of peaks and troughs in the various financial markets can be used as a framework for identifying the position of a specific market within its bull or bear cycle. The chronological sequence of peaks and troughs in the various financial markets can be used as a framework for identifying the position of a specific market within its bull or bear cycle. Within its bull or bear cycle. Chapter 3 Dow Theory. Chapter 3 Dow Theory. Introduction. The Dow theory is the oldest and by far the most publicized method of identifying major trends in the stock market. An extensive account will not be necessary here, as there are many excellent books on this subject. A brief explanation, however, is in order because the basic principles of the Dow theory are used in other branches of technical analysis. The goal of the theory is to determine whether the goal of the theory is to determine changes in the primary or major movement of the market. Once a trend has been established, it is assumed to exist until a reversal is proved. Dow theory is concerned with the direction of the trend and has no forecasting value as to the trend's ultimate duration or size. Once a trend has been established, it is assumed to exist until the reversal is proved. Okay. It should be recognized that the theory does not always keep pace with events. It occasionally leaves the investor in doubt, and it by no means infallible, since losses, as with any other technical approach, are occasionally incurred. These points emphasize that while mechanical devices can be useful for forecasting the stock market, there is no substitute for obtaining additional supportive analysis on which to base sound, balanced judgment. To base sound, balanced judgment. Remember, there are no certainties in technical analysis because we are always dealing in probabilities.